Fees and charges. This is certainly a biggie. Fees will vary from product to product and the provider of those products as well. Generally, the fees on your home loan could look something like this. It could be an establishment fee, which could also be called an application fee or an upfront fee or a startup fee or setup fee or anything along those lines. Look, they are a one-off payment in order to get the loan started. Sometimes when an establishment fee is waived, you as a borrower could face higher ongoing fees in other areas of the home loan. There's also lender's mortgage insurance. Now this will be a cost incurred if you do borrow in excess of 80% of the LVR. And it's a premium that is paid to the borrower and will protect the credit provider against any potential loss that is incurred if the borrower was to default onto their loan. Lender's mortgage insurance, though, isn't cheap and it can run into the thousands of dollars. It can be viewed as a way of getting into your property sooner, though, but it certainly is a cost that you have to be mindful of before moving forward. Lender's mortgage insurance is also directly linked to the loan-to-value ratio. So remember, 80% is the golden number. And, some may push their loan size to 95 or in excess of 100% in some cases. But, you really have to give strong consideration to that, because the higher the LVR, the more riskier that product ends up becoming. There's also ongoing fees. These could be known as administration fees or fees and charges to continue the administration and the management of the loan. They can be a couple of dollars to maybe $10 a month or so. There's break fees. These are fees that are charged for breaking a fixed rate loan contract, and generally they're very high. There's discharge fees. This may be charged when the borrower pays out the mortgage in full. Look, fees and charges are going to be subject to change at any given point in time, so be sure to read your product disclosure statement carefully so you don't get caught out with any nasty surprises. So previously we discussed 40-year home loans as being a pretty risky product, but there are a couple of others out there that have more than the average amount of risk associated with them. So beware, I guess. Risk is coming back into vogue, and that means that there are some products available that arguably could get you into your home sooner, but also will carry a sledgehammer to whack you if you were to slip up. So some of these products include no deposit loans and also family guarantees. Now, no deposit home loans are pretty risky because it's the way that the loan is actually structured. It doesn't actually give you any room to breathe. If you're borrowing 100% of the value and then add another $10,000 to $20,000 of expenses, you're already borrowing in excess of the actual valuation of that property. You really need to secure a fantastic property deal to make this work, because there's going to be very little equity, if any, available within the property, meaning that if you were to default on the loan, you won't be able to repay the mortgage if you sell the home. The lender, with the protection of the lender's mortgage insurance, will recoup their losses, and then the insurance provider could then come hunting for you to make up their stuff, while their loss and their shortfall. Ugly scenario to be in. Now, guarantees, or using a guarantor. I've used one in the past. If you do have access to them, it's fantastic. But proceed with some caution, and I guess more so for the guarantor's perspective, they have to really be made aware of what their requirements are and what would happen should the main lender actually default on their commitments. Using a guarantor, though, is a great way to avoid the lender's mortgage insurance component. And, it's quite possible to work, but, the family member that is acting as a guarantor really has to be comfortable and confident that they can also cover any losses that may be occurred in the process as well. So it's something that needs to be discussed in a very fair manner before proceeding ahead. And again, I would strongly encourage legal advice to be sought. So how do you actually go about securing the first homeowners grant? Well, the grant was actually introduced in 2000 to offset the effects of the GST. Basically, state governments will offer the first home buyers grant as a one-off as long as the eligibility criteria is met. Now, each state and territory, like we covered previously, has different rules that govern this grant, and you need to do your own investigation to get the most up-to-date information. We have included a table for your review, and we've also included some slide decks in that previous presentation. But to provide a quick snapshot of what a grant looks like across the nation, we've also provided in the tools and templates a handy link guide for each of the First Homeowners Grant websites. Or you could also refer to firsthome.gov.au. Basically, the process is filling out a form and registering the form, along with providing certain documentation to prove the purchase has actually taken place. And the same would apply if a stamp duty concession was applicable within your state as well. Rolling over and playing dead. Now, what do I mean by this? Why is it that it's the worst time to become complacent? When the deal is going through the final stages of finance, or when you're reviewing the contract of sale, when you're dealing with mortgage brokers, conveyancers, and building and pest inspectors, it's where deals can come unstuck. And I highly recommend that you don't be complacent within these aspects. Mistakes can be made, and mistakes can be costly. Let's admit it, the process of buying a house is intensive and it's tiring. But when you're at the finishing line, the worst thing to do is not maintain the momentum. So here are a few tips of wisdom and things that I've learned along the way. Documentation. Documentation can kill deals. You really need to have your admin in order. You need to have your ID, your bank slips, your bank accounts. You need to have that all in order and available when requested. If you take too long to get this all together, you could miss settlement. You could miss the finance clause within your contract and the deal could fall over. You could lose your deposit. Remember, the wheels and banks can move at a slow pace. If you're using a mortgage broker, they can only do so much at times to influence the outcome. You do have a finance clause. In Queensland, it is 2 weeks, but you really need to have that documentation together at the beginning so you can really maximise that full use of those 2 weeks. And chances then will be pretty good that you'll actually make it well within the deadline. The second aspect is to read contracts in full. Contracts are absolutely king, and if you've got any questions, ask. It's very important to get specialist advice and get a conveyancer or get a solicitor to review the contracts and look at what you're entering into. Know what you're signing before you're actually entering into that arrangement. There are a lot of circumstances when people enter into contracts being totally unaware of the full conditions, only for it to bite them on the arse at the end of the day. The final legal responsibility actually lies with you. So be sure to ask and don't be afraid either, as there's no such thing as a dumb question. The second aspect, or the third aspect I should say, I beg your pardon, is to really pay close attention to building and pest reports. And don't freak out over a bad one either. Housing inspectors and pest inspectors will err on the side of caution to indemnify themselves. But, they could be a really good tool to bring you back to the negotiating table. Other factors to be considerate of, because these are the factors that hold up the process. And it's typically at the finance end where you'll see delays. And, you've also got to take into consideration at what stage of the loan cycle it is. and delays can happen at each and every point. Firstly, is it pre-credit? This involves the assessment of your needs, the collecting of the data, analysing it, identifying a solution, and then submitting the application. Next is the credit component, where banks will receive the application, they'll collect and verify the data, assess the application against their own internal policies and underwriting, and then they'll either approve it or not. Now, post-credit, this is basically where they're going to determine the collateral and obtain the valuations. They're going to negotiate the security and the conditions and prepare and send out a letter of offer. There's pre-settlement, which is where you would sign the letter offer, and the credit provider's security and collateral documentation, and then organise for settlement to actually take place. Now, settlement is when you return all the documents and the credit provider for the settlement action to basically attend the settlement. Now, if there's a mistake in the documentation, they will have to be reissued. If your name is spelled incorrectly, or they've got the address of the property user's collateral incorrect, all that documentation will have to be reissued, again causing delays. Post-settlement, you also have to go through the process of stamping the documents and registering the mortgage. There's a lot to be done, and your conveyancer or your solicitor will help you work through these processes that are ongoing concurrently. But there's lots of things that can happen, so really be cautious. And when signing documents, particularly for short settlement periods, better still, have your finance pre-approved before you start house shopping. Mortgage brokers will do their best to keep the momentum going, as will real estate agents and conveyancers, because no one wants the deal to fall over. But sometimes things are out of everyone's control and they will cause delays. So be on top of these things. Preempt them. Preempt them and make sure your deal goes through in the long run. And sometimes, customer service disappointingly can be slack. No news sometimes is not necessarily good news. Work with people who communicate. You need to be informed and you need to know where things are at. Liaise with the real estate agent, liaise with your broker, liaise with your conveyancer, and get them to inform you where things are at. You're paying them at the end of the day, so make sure you get them working for you. So that now brings us to the end of Ruling the Roost. I hope you found that informative. Now I have to remind you, for those of you who have not actually booked your strategy session, look, I want to make the point of it to emphasise for you to really take up on that opportunity. It's the time when we can actually sit down together and work through devising a plan that's going to be appropriate for you to get you buyer ready. If that means setting up a structure and working out a suitable budget, let's do it. If that means getting you pre-approved and putting you in contact with some real estate agents in my network or property marketers, let's do it. Let's get you moving towards your home ownership dream, and let's get you moving towards securing your financial future. You just need to know where your attention's at, and we're going to work with you so you can decide when it's right for you.